welcome everyone. It's terrific to be able to join you today and to be asked to share some reflections on Australia's economic performance during the pandemic. I thought it might be helpful to begin by briefly recapping where we thought the economy was heading just prior to the outbreak of the pandemic, because that gives us a bit of a baseline against which to measure the shock that subsequently hit us. So as you can see here, in early February last year, which in some sense feels like a lifetime ago, our central expectation was that growth would pick up during 2020 and that we would see growth rates of around 3% thereafter over the forecast period. I just draw your attention also to the historical forecast errors, which are represented here in the shading. It suggested that growth below 1% was highly unlikely. Just for background, these error bands or confidence intervals, they're based on forecast misses going back to the early 1990s. And this stronger growth path was expected to take the unemployment rate from the low fives down into the sort of high to mid fours. And then with lower unemployment, the central expectation was that inflation would trend higher toward 2% by mid-2022. Needless to say, none of these projections came to pass. Now, at the end of each year, the bank runs an exercise where it looks back at its forecasts at the start of the year, and it's fair to say that the forecast errors that we observed last year were just of an order of magnitude larger than anything recorded before. And that brings me to the first takeaway for the afternoon, and that is that while recent historical experience, by that I mean the last few decades or so, is often a good starting point for thinking about uncertainty and thinking about a range of possible outcomes for the economy, recent historical experience can only ever really be a rough guide to the future. And so if I roll forward a year or so, it quickly becomes evident here that the first thing that was highly unusual about the recent downturn was just the sheer magnitude of it. So the decline in activity over the first half of 2020 was around 7%, mostly concentrated in the June quarter. And as this chart makes clear, this was easily the largest contraction in the history of the quarterly national accounts, going back to 1959. There are a couple of main explanations for the severity of the downturn. First was the restrictions on activity that were a necessary outcome of the public health measures put in place. And then secondly, a bit later, precautionary behaviour by households. And it was around this time that we, along with Treasury and other forecasters, feared the unemployment rate could double to 10% or maybe even worse. As I'll speak to in a moment, the subsequent lifting of restrictions because of favourable outcomes on the health front, combined with a really unprecedented policy response and a decline in precautionary behaviour, all of those factors have allowed output, that is the level of GDP in the Australian economy, to return back to around its pre-pandemic level. And this has really put Australia in rare company. There's very few economies around the world that have enjoyed a rebound like ours. Now, as enormous as the decline in output in the first half of the year was, just for the students of history among you, it'd be remiss if I failed to mention that some forensic archival research by a couple of my colleagues actually found that if you go back prior to 1959, there were a couple of periods where Australia suffered an even larger decline in output, in particular during World War II and during the Great Depression. But unlike the Great Depression, the economy has rebounded almost as rapidly as it declined. And in fact, the recovery really doesn't look like any other recovery in our history, and this will be a theme that I come back to throughout the presentation. And it certainly begs the question, why? And I think really the place to start here is to acknowledge that the nature of the shock has really been unprecedented. That is, we've never had a period where the supply side of the economy was so severely disrupted as a result of the mobility restrictions and other restrictions that came into effect because of what we were facing on the health front. And so this was not a standard demand-led downturn. Its origins were more from the supply side. Now, in time, we did see demand response assert itself. Precautionary behaviour by households and firms certainly contributed to the contraction, but not necessarily in the usual ways, and it certainly didn't kickstart things as is normally the case in recessions. And so by the September quarter, the supply shock started to abate as activity restrictions started to lift in response to better health outcomes. And the positive momentum that started in the September quarter has really continued right up until the present times. So complementing the easing of restrictions, there was another key development here that's explained the very sharp rebound in activity. And what I'm referring to here has been the very significant policy response, fiscal and monetary, which started to really take effect around the middle to latter part of last year. You can see here that the fiscal response by the Commonwealth and state governments was very, very large, the largest in peacetime. And that fiscal support was reinforced with monetary easing from the Reserve Bank, and also other temporary relief measures like rent reductions and mortgage deferrals, all of which meant that household and business cash flow behaved very differently to past downturns. And this is really another, I think, example, a manifestation of how this time really was different. As you can see here, household disposable income actually increased during the most recent downturn. And in fact, in the second half of last year, household disposable income was growing at its fastest pace in nearly a decade. And this income growth, this very strong income growth, unusually strong income growth, was occurring at a time when consumption possibilities were being restricted, particularly in the services sector. And so this contributed to a very, very large increase in the household saving rate, certainly far beyond what we had seen in earlier downturns. And another example of how this downturn was different could be seen in corporate balance sheets and business profits. You can see here that the black dot in this chart represents business profits over the 2019 calendar year. You can see in Australia, business profits ended the year higher, nearly 10% higher, in fact, than they started. And this has really been that again is historically extremely unusual. We saw business profits in North America also higher on the year. A key part of this was the nature of subsidies that were provided by certain governments. That's depicted here by these orange columns. You can see in Australia's case, had subsidies, in particular the wage subsidies through the JobKeeper program, not been delivered, then almost certainly you would have seen a significant hit to business balance sheets and business cash flows. So to sum up, it wasn't just the lifting of the supply side restrictions on economic activity that helped the economy to bounce back. The other key ingredient has been the enormous policy support, fiscal and monetary, that's left households and businesses in a financially stronger position than before the pandemic. And this has supported the pickup in aggregate demand as restrictions have been eased. Now, I've focused so far on activity and output. Let me now turn to a discussion of the labour market, because during the pandemic, this is where really where we've learned a lot about the ability of public policy to limit economic scarring effects. And what do I mean here by economic scarring and labour market scarring in particular? There's a couple of ways in which scarring effects can operate. One is where workers' skills decline, or in the eyes of employers are perceived to decline, because some people have been out of the workforce for a long period, or because their skills have been underutilised for a long period. Scarring can also occur where the skills used in previous jobs were very specific to a particular firm or particular industry and not well suited to other settings. And what we know from previous downturns is that the longer someone is unemployed, the greater the likelihood that scarring effects begin to take hold. And when that happens, workers can be viewed essentially as unemployable or only employable on much reduced wages. And you can see from the graph here that in the downturns of the 1980s and 1990s, the unemployment rate after the initial contraction in activity, the unemployment rate continued to rise for a couple of years. And what's not shown here is that it subsequently took many years for the unemployment rate to get back down to pre-recession levels. The fear of a repeat occurrence, or even worse, was absolutely front of mind when policymakers formulated their response to the pandemic. And as I mentioned before, in terms of targeted labour market responses, the centrepiece really was the JobKeeper program. Now, the JobKeeper program essentially was aimed at preserving the relationship between employees and firms through the worst of the downturn, certainly until the economy was back on its feet. I think that the success of that policy, along with other more general policies designed to support the economy, like the lowering of interest rates, meant that the increase in unemployment was much less severe than we originally feared, and certainly much less severe than what we'd seen in earlier downturns. As you can see here, it didn't rise nearly as much or for as long as what we saw in the 80s or 90s. And in fact, it started to rise in March, but by July of last year, the unemployment rate actually stopped increasing and has been declining ever since. If I put these developments in the unemployment rate into even broader historical perspective, you can see here the increase in unemployment that we saw, as challenging as it was nothing like what we saw in Australia's two previous depressions in the 1930s and the late 1800s, where the unemployment rate got to as high as around 20%. And in the 80s and 90s downturns, the unemployment rate exceeded 10%. That was certainly what we were concerned with. In the end, the unemployment rate peaked at around 7.5%, at a much lower level, and it peaked a lot earlier than we feared. Now, before I turn to the outlook, I wanted to just step through a final unique feature of the current episode, which has been how uneven the effects of the pandemic have been across the economy. In particular, some parts of the economy have prospered, some regions, some sectors, while others have been particularly hard hit and are still finding conditions very challenging. And one way to begin to look at this is through the consumption of goods and services. The consumption of discretionary services shown here, the red line, you can see it fell precipitously in the early stages of the pandemic. Things have recovered some ways. There's still a fair way to go. By contrast, the consumption of some types of goods is well above pre-pandemic levels. So it's been very uneven in terms of the consumption of goods versus services. Another way to think about the unevenness of the shock relates to or connects to the closure of the international borders in early 2020. That has seen net overseas migration, shown here in purple, to turn negative, and for population growth to decline to its slowest rate since the First World War. This has also had very uneven effects across the economy. It's obviously had a severe effect on firms operating in the international tourism industry and parts of our education industry that are reliant on foreign students. And that's been particularly the case where domestic sources of revenue haven't been able to fill the void. And it's not just revenue sources that have been severely affected in certain industries. Constraints in the supply of labour have also been experienced by a number of firms, a number of industry. Firms in the food and hospitality trade have struggled to source temporary workers. Similarly, in the farming and agricultural industry, which typically rely on working holiday makers, they have also reported difficulties in finding workers. And the housing market has been another area where this unevenness has been apparent. The decline in international students and temporary residents, as well as a sharp decline in tourists and business travellers, all of those things together have reduced demand for long and short-term rental accommodation. But you can see here the rise in rental vacancy rates has been most pronounced in Melbourne, to a lesser extent in Sydney. And you can see in the bottom panel, advertised rents are still declining in Melbourne. And that's particularly the case for inner city apartments where, for instance, international students tended to reside. But you look at other parts of the country where foreign students and international tourists are relatively less important to the overall state economies, and rental vacancy rates have actually moved in the other direction. You look at the bottom panel in yellow, you can see that advertised rents in other capital cities are now growing at a double-digit pace, and that's especially true for regional Australia. So good segue to say a few words about what's been going on in regional Australia. Last year, net internal migration to regional Australia totaled a little over 40,000 people, which was the largest volume of people on a net basis moving to regional Australia in the 20 years that the ABS has been compiling these data. And that reflects two things. One has been an increase in arrivals from capital cities that I'm sure many of you have read about or even experienced if you've tried to get a coffee at a cafe high street in regional Australia in the school holidays. But in addition to that, the second influence has been people in regional Australia have stopped moving to the capital cities, certainly in the way that they would typically do so. So there's been more people from the cities moving to the regions, and people who would typically leave the regions and come to the cities have stopped doing so. And those two things have resulted in a big pickup in net migration to regional Australia. And we've seen those net flows particularly strong in the case of New South Wales and Queensland. In the other states, where you typically see a net flow out of the regions to the cities, depicted here by the grey bars, in places like Western Australia or South Australia, that typical net outward flow of people from the regions, that's dried up almost completely. So stepping back, let me say a couple of things. It's clear the economy is undergoing a period of significant change. That's included not only significant decline in international visitors, but also important changes to the way that Australians live and work. And the economic effects of fewer international visitors on particular industries and regions, it's still evolving. And some firms, some industries, some parts of the country have been better able to adapt than others. So to sum up there, there have been a number of unique elements to the events of the past 15 months or so. It's really been anything but a standard downturn and recovery. Let me change gears now, and I'll spend the remainder of my remarks discussing some elements of the outlook and some of the key points from our updated forecast, which were published on Friday. The first point I want to leave with you is that the Australian economy is transitioning from recovery to expansion phase much earlier and with more momentum than we anticipated, which is great news. GDP is now expected to have reached its pre-pandemic level in the March quarter just gone. And it's worth noting also there were more people employed in March than before the pandemic. In response to this, the stronger starting point for the forecast and the better outlook further out, the baseline scenario for GDP and unemployment is better than we expected 3 to 6 months ago. Under our baseline scenario, we expect GDP to grow by around 4.75% over 2021 and 3.5% over 2022. This is a fair bit above trend. You can also see here the level of GDP is expected to remain a little below the level forecast before the pandemic, but this is really due to lower population growth. In per capita terms, GDP is expected to be on a higher trajectory than before the pandemic. A strong household spending is really central to these forecasts for activity, and we think there's 3 or 4 underlying drivers of consumption that will help underpin our forecast for GDP growth. First of all, a further lifting of activity restrictions, and this will mean that more consumption possibilities become available, including for services. A second support here is a stronger outlook for household disposable income. Because we think employment growth will run a bit stronger, more people will be working more hours. That will translate into higher income, and higher income will in turn support higher consumption. We also expect there to be positive wealth effects from higher asset prices, including higher housing prices. And we anticipate that a gradual decline in uncertainty will also help support consumption, certainly relative to saving. And so as a result, we see the saving ratio as shown here in the bottom panel. We expect that to decline from around 12% where it was in the December quarter, down to around 8% by the end of this year, and then further out, it'll return to just above its pre-pandemic level. Turning to the labour market, employment growth is expected to remain strong certainly in the next few months, given the momentum we're seeing in activity and given we're seeing forward-looking indicators of labour demand are pretty buoyant at the moment. Other information we've got available suggests that the end of the JobKeeper program in March should not be too disruptive to the labour market. So in the near term, the employment picture is looking quite favourable. And further out, we expect the general level of activity to be sufficient to continue to drive employment growth over the forecast period. We expect labour force participation to increase a little bit over the year ahead as more people are drawn into the labour force because there's more opportunities for employment. Because of this, the unemployment rate is expected to continue to decline to around 5% by the end of this year, and further to around 4.5% by the end of the forecast period in mid-2023. This is a fair bit better than we had expected just a few months ago. And the lower unemployment rate forecast is consistent with our forecast for wages growth and underlying inflation to pick up a little bit faster than we had previously anticipated. So the faster improvement in the labour market, in turn, we expect to result in spare capacity in the labour market to be absorbed a bit more quickly. And this should put some upward pressure on wages growth over time. This upward trajectory in wages growth, though, is coming off a low base. You can see that toward the end of last year, wages were growing at their slowest pace in more than 2 decades. So it's encouraging that we expect wages growth to pick up, but it's really coming from a low base. But as I'll speak to in a minute, the extent of estimated spare capacity in the economy it's highly uncertain, which means it's certainly plausible that wages growth and inflation could be a bit slower or faster than we expect in the baseline scenario. And I'll say a bit more about that in just a moment. So you can see here our profile for inflation. Again, like wages, coming off a low base. We're encouraged that it heads up toward 2% by mid-2023, but inflation pressures have been quite benign for some period of time. So the process is going to be a gradual one. That uplift inflation that we're expecting is going to be, it'll occur at a sort of modest pace and be gradual. Now, I spoke about there being a high degree of uncertainty. Let me now just conclude on this slide with some final reflections around different possible states of the economy and alternative paths that the economy may take based on different assumptions. So that while our sense is that overall households and businesses are adjusting well to the tapering of fiscal and other temporary support measures, the nature and the speed of the next phase of growth, it's still characterised by, I think, a high degree of uncertainty. And the outlook's still going to be very uneven across industries for some time. And that reflects a whole number of factors, that the international border remaining closed for some time, ongoing restrictions in parts of the services sector. There's big shifts still underway in consumer preferences. Some supply disruptions are ongoing, and of course, slower population growth is going to be with us for some time. And so given all this uncertainty, what I've shown here and what was published in the S&P last week are a couple of alternative domestic scenarios, an upside scenario and a downside, which we've based largely on different assumptions for household consumption. So a stronger trajectory than the one envisaged in the baseline scenario would be possible if households increase their spending by more than we expect. How might this play out? Well, it could be in response to wealth effects being a bit stronger, or because uncertainty in the minds of households declines a bit faster, and that contributes to households drawing down on their savings, which would reinforce already improving conditions in the labour market, which would in turn feed back into income growth, and then that would support more consumption and so on. And in that type of environment, you'd also expect private investment to be very strong as well. And so in that upside scenario, the unemployment rate is shown here to decline at a faster pace and to a lower level, around a little under 4% than what we relative to what we expect in the baseline. And this in turn would see inflation picking up to around 2.25% by the middle of 2023. So that's the upside scenario. The downside scenario, or another way of framing it, a weaker economic trajectory could, and so in this downside scenario, the forces at work would be wealth effects on consumption being smaller than we predict in the baseline. And we'd have a situation where households decide to divert more of their financial resources to strengthening their balance sheets, including by paying down debt. And so in this sort of a scenario, you'd expect subdued consumption, subdued private investment, very moderate growth in labour income, and the unemployment rate remaining above pre-pandemic levels in this scenario. And all of that would in turn result in underlying inflation remaining around 1.5% over the forecast period. So there are a couple of different scenarios, a couple of different paths the economy could take based on different assumptions around the ability and willingness of households to consume. But beyond this, there are other sources of uncertainty that are going to be with us for some time. And the first of those relates to global health outcomes. The uneven pace of vaccine rollout globally could still stifle the global recovery. And we could also see the emergence of virus strains that vaccines are less effective against. If that were to come to pass, this would clearly affect when international travel restrictions could be lifted, and therefore the pace of recovery in domestic services, trade and consumption. A second uncertainty relates to fiscal policy globally and at home. On the home front, one uncertainty here is whether the fiscal initiatives that have been designed to spur the recovery and dwelling and business investment, whether that has just pulled forward demand, or instead has it helped to set demand on a new high trajectory. The Home Builder program was extremely effective in boosting the pipeline of dwelling construction activity. It looks like business tax incentives have been also helpful in supporting a pickup in machinery and equipment investment. But we just don't know yet whether demand has just been pulled forward or whether now the trajectory has been shifted higher in a persistent way. A third source of uncertainty relates to housing and financial asset prices. It's always very difficult to predict where asset prices are going to go. If it turns out that the expected growth in household wealth fails to materialise, then it's plausible that consumption growth over the forecast period could be lower. And the reverse is true should household wealth increase by more than anticipated, because financial and housing prices increase very rapidly. And a final source of uncertainty relates to, I've mentioned this a little earlier, how much spare capacity might remain toward the end of the forecast period. Now, on the one hand, experience in the years prior to the pandemic suggested that the unemployment rate needed to be below 5%, possibly well below, before wages growth and inflation might be expected to pick up quickly. Currently, both wage and price inflation are at a much lower level than over the past decade, and because of inertia in wage and price setting norms, it may just take some time for price pressures to build, even if spare capacity is absorbed more quickly than we expect. And then on the flip side, just the fact that there's so much that's been unusual about recent events, including constraints in the supply side of the domestic and global economies, that could mean that domestic wages growth and inflation pick up earlier and faster than we expect in the baseline. This could occur due to an extended period of supply chain bottlenecks and firms' reduced ability to address labour shortages through interstate or internal migration, and hence they have to put up wages more quickly. So I've covered a lot of ground here. This is probably as good a time as any to pause and recap. A key point I wanted to leave you with was There are a number of highly unusual aspects to both the downturn and the recovery so far. The shock has been way outside the bounds of contemporary historical experience, but it's been really encouraging that the Australian economy is recovering strongly and beginning to transition beyond just the recovery phase into now the expansion phase. And so as a country, I think we should be proud of the progress we've made, but equally be cognizant that there's still a high degree of uncertainty that we're going to be grappling with for some time yet, and parts of the economy are still experiencing some pretty serious challenges. So with that, let me thank you all for dialing in today and for listening, and I'd be very happy to take any questions you might have.